After years of conversations with pre-retirees and retirees, I've noticed something interesting. How much money you've accumulated is not what determines retirement stability. And in this video here, I'm going to be walking through an article that I wrote that emphasizes that stability has a lot more to do with where you store your money as opposed to how much you've accumulated. So without further ado, let's hop into it. How much stability do you actually need in retirement? Most of the people that I meet with are not struggling financially. They're successful professionals, business owners, executives, and disciplined savers who have spent decades doing exactly what they've been told to do. They've maxed out their retirement accounts, they've invested consistently, they've built a meaningful level of wealth. From the outside looking in, they are doing everything right, which is great, so I applaud them for that, absolutely. And yet, one of the most common questions that I hear, or like just themes of conversations that I'm having, is how do I know if I'll actually be okay when I stop working? When I clock my ticket in and I'm actually retired, how will I know that I'll be good when I stop working? Now, what's interesting is that this question rarely comes from someone who hasn't saved enough. More often, it comes from someone who has accumulated a significant amount of wealth and is beginning to realize that retirement isn't just about accumulation anymore. It's about turning assets into income, right? That's what retirement income is all about. In fact, it should probably be called future cash flow planning, or even just like distribution planning, right? And over the years, I've noticed that retirement confidence has less to do with how much money you've accumulated and more to do with how efficiently, right? How efficiently that wealth can be converted into spendable income, right? That matters more than anything because believe it or not, way too many people are entering into this business relationship, if you want to call it that, with their Uncle Sam, and they had no say in terms of what that business arrangement was going to look like. We're paying so much money to Uncle Sam every single year, and I'm going to explain that a little bit more so in this article. And if only people knew, they would do things a little bit differently. So let's keep going. One of the first concepts I learned when I entered the industry was that there are three primary tax buckets where money can live, okay? It's gonna be taxable, tax deferred, and tax free, okay? Most people spend their entire careers focused almost exclusively on the first two. All right, so let's take a look at these three buckets here. We got taxable, we got tax deferred, and we have tax free, okay? So we got taxable, tax deferred, and we got tax-free. Okay, so within the taxable bucket, we're talking about savings accounts, checking accounts, money market accounts, brokerage in some cases, CDs, things of that nature. That's within the taxable bucket. In the tax-deferred account, this is where a lion's share of so many people's wealth ends up. We're talking about 401ks. We're talking about 457 plans. We're talking about 403Bs. We're talking about traditional IRAs. We're talking about SEP IRAs, right? The list goes on and on. If you're getting a deduction today, you're just kicking the can down the road for when you're going to need to pay those taxes eventually at an unknown tax rate. And so that's where a lion's share of most people's income or retirement income is actually going to be coming from. This is where a lot of their savings are. And then tax-free, we have Roth accounts. Some people say muni bonds, and I would actually put a question mark there. And then I'd actually say cash value, life insurance, in its various flavors that it comes in. Now, the reason I put a question mark on muni bonds is because from a federal perspective, yes, it is going to be tax-free, but depending on where you're getting that municipal bond and if you live in that municipality or not, that determines whether or not that's going to be free of state taxes as well. And also, does it count towards provisional income or not? That's also up for question. And in many cases, it likely would count towards provisional income if you're in a retirement phase. And so it ultimately could show up in taxes in a different way, causing your Social Security to become taxable. So that's why I put a question mark next to muni bonds. And so the tax deferred bucket is where most retirement wealth eventually accumulates, right? And again, I applaud these people for doing that. This includes things like the 401k, the traditional IRAs, the SEP IRAs, 403Bs, 457 plans, you name it, and other qualified retirement plans, okay? Now, for decades, Americans have been encouraged to maximize these accounts because of the upfront tax deduction that they provide. Now, this is one of those things where I feel like a lot of people think a lot about. They're like, well, if I'm going to get a deduction today, they're not thinking about the fact that in the future, I'm going to have to pay taxes on that money regardless of what the tax rates are. Okay, we want to save our money today, and there's nothing inherently wrong with that. We want to pay less in taxes today, and again, there's nothing inherently wrong with that. But what's the impact of that when you look at it macroeconomically throughout our lifetime, right? There's something more to be said about that. And to be clear, there can be tremendous value in doing so. Again, it's not necessarily a bad thing. But somewhere along the way, many successful savers became so focused on accumulating assets that they never stopped to ask a very, very important question. What happens when it's time to spend the money? Will it function the same as today, or will it be a little bit different, especially from a tax perspective? Every dollar coming out of those accounts will eventually be taxed. That's where I think many people unintentionally create future instability within their retirement plans. And in fact, it usually leads to one of the most common assumptions that I hear from people who have successfully accumulated capital over their lifetime, which is, I'm not worried about taxes in retirement because I'll probably be in a lower tax bracket anyway, okay? And my response to that is, maybe. I hope so. Question is, will that happen? Will it not? But let's think about it for a moment, all right? Most people focus on what tax bracket they'll be in. Okay, I get that. Very few stop to ask what the tax bracket themselves might look like. If today's 12% bracket eventually becomes maybe 20% or 25%, 30%, the entire calculation changes, and the gamble that you played, you ended up losing, right? And whether taxes actually rise, it really isn't necessarily the main point. The point is the uncertainty that you have here. Retirement planning or future cash flow planning or distribution planning, whatever you want to call it, isn't necessarily about certainty as much as it's about preparing for uncertainty. Now, when you consider our national debt, trillions and trillions of dollars of national debt, unfunded liabilities, and the fact that many economists, financial planners, CPAs remind us that we're currently operating in some of the most favorable tax environments we've ever seen in our lifetimes, I think it's reasonable to at least ask the question, what if tax rates are higher? If taxes ends up going higher, what impact will that have on the income that you're able to produce, and how much of an eroding factor will that play on the money that you have once you make it to retirement? And here's the thing, nobody knows, because nobody necessarily has a crystal ball. And that's exactly why flexibility and stability matter when it comes to future cash flow planning and retirement planning, right? And this is one of the reasons I became fascinated with the work of David McKnight in his concept of striving to get as close to the 0% tax bracket in retirement as possible. Years ago, I heard him discuss an idea that completely changed how I think about retirement income planning. And most recently, just like last week, literally from the recording of this video, I had the opportunity to hear him speak at a conference that I attended. The goal isn't necessarily to eliminate the tax deferred bucket. This is not the goal, okay? I think that's a little bit short-sighted and a little bit, dare I say, elementary of the viewership on that, is just eliminating the tax deferred bucket altogether. That doesn't necessarily need to happen. We just need to, quote unquote, right size it, right? Most advisors spend their careers talking about how much money you should put into a 401k because the assumption is that more is always better. But more is only better in the right context, right? And that's what I'm hoping to get at a little bit more so in this article here. Now, where your money lives, okay, this matters a whole lot. Where your money lives may just be as important as how much you've accumulated. The balance between your taxable, your tax deferred, and your tax-free buckets can have a tremendous impact on how efficiently you generate retirement income later on. The idea here is surprisingly pretty simple. In a perfect world, you would eventually reach retirement with just enough money in tax-deferred accounts that your required minimum distributions, or RMDs, remain at or below your available standard deduction. If that happens, those mandatory distributions may be absorbed with little or no income tax consequences, which is amazing. That's what we want. Anything above that begins to create additional tax exposure, which could have been avoided with proper planning, okay? That's a completely different way of thinking about retirement income planning, isn't it? Instead of asking, how much can I contribute to tax-deferred accounts, the better question becomes, how much should ultimately remain there once you make it to retirement, okay? That raises the very practical question. What does all this actually mean in retirement? And by the way, if this conversation has you thinking a little bit differently about retirement income planning and where you're going to be when that time comes, go ahead and use the link in the description or the pinned comment below to give you a little bit of guidance on where you should be heading, or just to kind of get the gears turning about what might be next for you when it comes to retirement income. Now back to the video. So let's imagine two retirees. Both have accumulated $2 million, both retire at age 65, both want $100,000 of spendable income. This is the main point that I'm gonna really wanna drive home here, is the spendable income level, okay? On paper, these two individuals, person A, person B, they're identical. In reality, their retirement accounts could look dramatically different. Now, here's what person A did. Person A did what many successful savers do. They accumulated the overwhelming majority of their retirement assets inside tax-deferred accounts and now need $100,000 of after-tax spendable income to support their lifestyle, okay? One of the most important retirement formulas that nobody ever taught us in school, and frankly, I haven't even received in formal financial education, is this. Required gross income equals your desired income divided by 1 minus the tax rate. So let's assume person A faces a combined federal tax rate of, let's call it 30%. And to generate $100,000 of spendable income, the calculation looks like this. We want $100,000 of net income, right? That's what that is, right? Then we take 1 minus 30%, which is the tax rate, right? Which equals $142,857. In other words, person A must withdraw nearly $143,000 just to spend $100,000. That's $43,000 just gone, disappears, that you'll never be able to see again, disappears to taxes, okay? That's nearly $500,000 of taxes over a 10-year period just to generate the same lifestyle, okay? Now, the story doesn't end here, unfortunately, though. And I don't want to be a Debbie Downer, but this is what a lot of people are actually having to go through. And people are making it to retirement, and some of them are saying, it feels like I'm paying more in taxes in retirement than I was when I was working, and I was making more when I was working than I am now. And it just kind of blows people's minds a little bit. And so this is the reason that they feel this way. Those withdrawals may increase something called provisional income, which is the IRS formula that's used to determine how much of your Social Security benefits become taxable. Okay, so it can increase provisional income calculations, okay? And they may also increase Medicare premiums through something called IRMA, which is basically how they determine what your Medicare premiums will be. And every future tax increase creates additional pressure on retirement income. So one withdrawal can create multiple consequences, including income taxes, taxation on Social Security, and remember that was a tax basically throughout all your working life, so now you got to pay taxes on that again. If we can avoid that, why not avoid that, okay? And potentially higher Medicare premiums as well, right? This is something that I would imagine most people don't want to have to deal with, right? Don't want more consequences just for living their life, okay? And if you have proper prior planning, I think you'll be in a position where you pay zero or maybe just minimal level of taxes than you would have otherwise. Anyways, it's entirely possible for some retirees to find themselves paying more in taxes during retirement than they did while working, like I mentioned before. That's a lot of friction between accumulated wealth and spendable income, okay? So now, let's look at person B. Person B also wants $100,000 of spendable income, right? Net spendable income, okay? But their assets are intentionally spread across multiple tax brackets, and they did it on purpose, right? Let's assume their income comes from $20,000 of tax deferred, okay? And that fit within available deduction space, maybe $30,000 from Social Security and $50,000 from tax-free assets such as maybe Roth accounts and properly structured whole life insurance, which I talk about so much on this channel. Their spendable income is still $100,000. Their lifestyle is identical. Their retirement goals are identical, okay? But the amount of taxable income that's recognized may be dramatically lower. Okay, and so the result is that person A, again, needed almost $143,000 just to realize a net income of $100,000, i.e. spending power. Person B may only need $100,000, make $100,000 exactly of gross income to create the exact same lifestyle. So they have the same net worth, at least that's how they started. They have the same retirement, right? At least that's how they started. And the same spending, which is what they're creating every single year. And yet the net results for both of them are going to be completely different in their erosion of person A in their account because of the taxes that they'll never be able to spend. It's going to really put them in a position that they would have otherwise preferred not to be in, okay? And so again, all of this boils down to a very different tax outcome. And this is where I think many people misunderstand the role of cash value life insurance in retirement planning. When most people hear life insurance, they immediately think about death benefit, or maybe they're asking, what in the world does life insurance have to do with the retirement cash flow? What they overlook is the role that properly structured participating whole life insurance can play as a source of tax advantage, likely tax-free liquidity later in life. Not as a replacement for investing, because generally speaking, overfunded whole life insurance isn't an investment in the traditional sense anyway. Not as a silver bullet, and not as an answer to every financial problem either, right? And definitely not as the sole retirement account, okay? Instead, think of it as another source of capital that creates flexibility when taxes or the stock market or retirement income planning demands different options, because flexibility and stability are ultimately what we're trying to create here. That becomes even more important when we consider another risk that retirees face, which is something called sequence of returns risk. This refers to the danger of experiencing significant market declines during the early years of retirement while simultaneously taking out withdrawals. The first decade of retirement is incredibly important because two retirees can earn the exact same rate of return over 30 years and still experience dramatically different outcomes depending on when those occurs happen. So a short way of describing the sequence of returns risk is the risk that the stock market returns are not panning out in your favor. That's how I like to describe it. A severe market decline early in retirement can permanently damage a portfolio if withdrawals continue during the downturn. That's why I find myself focusing less on rates of return and more on flexibility and more on results, okay? And the more options you have for generating income, right? Options are better. If you want more of anything, focus less on more money within the 401k and more on more options that you have to draw money from, okay? So the more options you have for generating income, the less pressure you place on one single asset. You don't always have to sell investments when markets are down. You don't always have to create taxable income when it's inconvenient, right? You also do not always have to rely on one singular tax bucket. You have choices, or at least you can have choices. And over the years, I've come to believe that choices are what create stability, okay? Choices are what create the stability that you're looking for. I've met people with millions of dollars who remain extremely anxious about retirement. I've also met people with far less than $1 million feel pretty confident about their retirement. The difference is rarely about the size of the portfolio, okay? It's not about how much money you've accumulated per se. The difference is usually about clarity and flexibility and how much stability you're going to have in retirement. They understand where their income is going to come from, right? These people who may have less than $1 million, but they know that they're going to be fine because they understand where their income is going to come from. They understand how taxes might just affect them. They understand how market volatility could impact withdrawals. And more importantly, again, they have options, okay? Retirement confidence isn't just about wealth. It's about knowing that no matter what happens with taxes or the stock market or inflation or legislation, you have multiple ways to respond. And over the years, I've come to believe that stability isn't created by having more money. Stability is created by having more options. There's that word is again, okay? That's the pattern that I want to kind of have you hear over and over again, because having options, you see it 3 different times on this one page, that matters way more than just a higher account balance, okay? And the people who seem to enjoy retirement the most, regardless of how much money they have, aren't the ones with the largest portfolios per se. They're the ones with the greatest flexibility, with the most options. So here's a question that's worth considering. If you personally needed $100,000 of spendable income tomorrow, or you're in retirement, you need $100,000 of spendable income, how much would you actually need to withdraw to realize $100,000 of spendable income? Would it be $100,000? Maybe $120,000? $140,000? Maybe more? How much would it be? Most people know what their net worth is. There's some idea of that. Far fewer know the cost, the true cost of converting that net worth. This is the main piece here, converting the net worth into income. And in my experience, that realization changes the entire retirement conversation. One thing that I've learned after years of working with successful accumulators is that people tend to think about retirement very differently. Some people are focused primarily on income, others are prioritizing flexibility, others may be thinking about legacy primarily, and some just aren't ready yet. And understanding how you naturally think about retirement can bring an incredible amount of clarity to future planning decisions that you're gonna have to make anyway. And so that's exactly why I created a very simple retirement self-assessment designed to help people identify which retirement mindset they most closely align with before making any financial decisions. And that's exactly why I created a simple retirement self-assessment designed to help people identify which retirement mindset they most closely align with before making any major financial decisions. And so I hope this video was helpful. If you have any questions whatsoever, go ahead and let me know them in the comments. And don't forget to take the self-assessment that you can find in the description or the pinned comment below. And I'll see you in the next one. Thanks for watching.